So what we do is this Hanseatic Blockchain Institute is something that has been founded by Omri and me and some other Hamburg-based entrepreneurs who had
Hmm.
interest in blockchain back in 2017. So we are around for
Hmm.
quite some time. And
Hmm.
amongst the things we already did is this Blockchain Monday. And for a while, we met each and every Monday and always had a speaker,
Oh.
sometimes coming flying in. And then, of course, COVID came and made it a little bit more difficult. And we
Hmm.
switched to this format. We always try to have kind of new insight by like today by inviting founders of blockchain companies. And
Hmm.
I think what you do with Polli is quite eye-opening for everybody who is a little bit deeper in the blockchain space. Therefore, I'm very happy to have you on board. And maybe just before we start into the presentation, can you give us a short introduction how you initially got across blockchain and what made you dig deeper into it? What was your first kind of moment when you came across this thing?
Cool. Of course. So I've been in blockchain or in crypto since 2013.
All right.
I came across the Satoshi white paper,
Yeah.
and it kind of like it blew my mind pretty much. And I thought that I was looking at sci-fi. It's something that's just like came out of Star Wars, and I was like, okay, let's kind of go down this rabbit hole.
Yeah.
So I bought my first Bitcoin in 2013,
Me too.
and amazing, amazing.
Yeah.
Look, good for you. And then after that, I got into ICOs. And the first ICO, I was very fortunate to participate in the Ethereum ICO. Um, and After reading the white paper of Ethereum, I mean, first of all, I've been avidly learning about blockchains and and the evolvement of the technology again as a private investor, which I've been doing that for 13 years now. My professional background is also in product and in technology, which I've been in for 16 years already. Um, and so I knew that once, like this convergence of blockchain and product, there were two things that I really, really loved and enjoyed. So that's something I was always researching. Now, in 2014, when I looked at the Ethereum white paper, something really caught my eye, and that was the whole notion of POS networks. Um, it was just fascinating to me, that you can secure a network and you can generate passive income from it. Um, and I found myself, waiting for it for about want to say 5, 6 years, something like that. And then I got into staking kind of around the end of 21, started just, dabbling with it, playing with it. And then in 2022, I went through a personal, call it life event, which basically I couldn't work for almost a year. And the only thing I could do was stake. Now, as I was basically what I did in staking was I started a simple index. Um, During the period that I could not work, it used, as a financial lifeline. It actually turned into a professional lifeline also because the only thing I could do is just like dig into what's going on with stake and across like 6 protocols, and I would see and like just see that the things so something there was not right. It wasn't 100%. Like the yields that you were told that you were generating, they weren't really that wasn't really the case. And I would ask myself, hey, listen, this is like decentralized. Why am I being placed into one validator? It doesn't make sense. And I started looking into it, moving forward into the beginning of 23 until the SEC fined Kraken, where eventually everything that I had, established on Kraken. Not that it's too much, it's too hard, but everything just stopped. And then I had to start everything, from scratch by myself. So I started looking into, okay, I was like, okay, I mean, 6 protocols. I need to find validators. I need to start comparing them. I mean, Ethereum, I did Ethereum staking through Kraken. There was no delegation at the time. So I had to set up, figure out how to set up my own validator. So eventually I set up my own Ethereum validators. I started researching, different validators across different networks, and I saw, and it really started going down that rabbit hole. And you know, Polli in the beginning started as something that I wanted to use personally for me to kind of manage a multi-chain portfolio. But as I
Yeah.
was going deeper and deeper and deeper, I started to see there were real problems in staking, and that it was inaccurate. It was centralized. The returns were not, were not what they were, what was being posted, and more so, like one of the biggest questions that I walked out with was like, I don't understand. This is a process that's supposed to make networks decentralized, and yet large validators are making it more centralized. It didn't make sense. So once I started building with my team, we started to discover many interesting things. And Polli originally started as a yield optimizer. And during our journey, as we moved along, we actually saw that what we were providing was much more than that. We were actually providing allocation, which generates a balance between security, decentralization, and yield, which we're going to be talking about today. So, kind of like in a nutshell, that's my personal story with Polli and where we are today.
All right. Okay. So how many people are working with Polly now? What's the team?
We're a team of about I want to say 7 people or 8 people at the moment,
Yeah.
which are the team was small team, moving very fast, very efficiently, and we have multiple networks which we're going to be presenting today.
Yeah.
Yeah.
All right. Perfect. Let's step into it and
Okay.
please share or let's move through the presentation, and all of the people in the audience, please actively use the Q&A function so we have it as interactive as possible, and you can pose your questions as soon as you have any.
Okay. Beautiful. So, hi, good evening, everyone. My name is Elay Carmon, and as I said, I'm the co-founder and CEO of Polli. Tonight, I want to share with you something that doesn't get enough attention in crypto. It's not price. It's not the next hot protocol. It's not the next narrative. I want to talk to you about a structural problem that sits underneath all of it, and why solving it is one of the most important things that can happen for our industry right now. And that problem is allocation. I believe that by the end of this presentation, you'll see it differently than you did when you walked in. At least $600 billion are staked across crypto networks today. And that's just staking. When you add the capital flowing into restaking, DeFi, stable coins, and what's coming with RWAs, you're looking at trillions of dollars that will require efficient security on chain. Here's the problem. Almost all of that capital is being deployed the same way, statically, manually, and without any intelligence behind it. That's not a small operational inconvenience. It's a structural gap at the foundation of how this market works. Yeah, okay. Most delegations in crypto are made once and never revisited. Validator selection is based on who's most visible, who has the best brand, who someone heard about at a conference. Not performance, not data, but brand. And when market conditions change, when a validator starts underperforming, when concentration builds up, when yields diverge, that capital doesn't move because no one is watching, no one is managing it. And managing, hiring a fund manager who picks one stock, goes on vacation, and never checks in again. That's how most staking works today. The consequences are real and they're measurable. Between 10 to 30% of potential yield is left on the table simply because capital isn't being managed actively. When stake clusters around a few large validators, networks lose the decentralization that gives them their security guarantees. That's not theoretical. That's happening right now across major chains. And institutions who are already in this market are operating without the infrastructure they actually need. They can perform at a basic level, but not at the standard their mandates demand. The root cause is simple. Misallocation isn't a bug in the system. It's a default state of how crypto capital gets deployed. And here's what makes it dangerous. It compounds as the market grows. More capital, more networks, more yield sources with no systemic solution in place.
Just to ask this assumption
Yeah,
that even the institutionals are not kind of actively monitoring the staking. Is it an
yeah.
assumption, or have you been in touch to some of the large scale institutions
So we have. And so, I
and
mean,
they all have
they
the issue?
Yeah, I mean, they monitor once every like when they monitor every once in a while. Most of them work with one provider,
Yeah,
maybe two, maybe three. But still, even if they do, they don't necessarily, manage the allocation between them. The capital that sits within those providers is static,
yeah.
and it doesn't move, and it hurts the networks and it hurts them in terms of the returns. So yeah, this thing is very, very real.
Okay.
Um, Now, let's talk about the scale of the opportunity. So let's look at each category. First of all, staking, delegated once, rare. Oh, sorry, I think I skipped. Yeah, there. Wait, here it is. Yeah.
Sorry.
Okay. So no, excuse me. Hold on. I'm sorry. Yeah, I got a little confused here with the slides. Yeah. So we just went over with this. Okay, let's move on with this. Okay, fine. Okay. So let's zoom out for a moment, okay? Because the scale of what we're talking about here is important. Today, staking alone is $600 to $900 billion today. In the near term, stablecoins are at 312 billion dollar market cap, out of which only about 35% is actively deployed in yield generating positions. And DeFi is currently at 130 billion dollar TVL. The rest is sitting idle. Now, on the horizon, RWAs, which are already at 20 to 36 billion on chain today, with projections surpassing 10 trillion over the coming decade. Every single one of these categories has the same underlying problem. The capital exists, the yield exists, but there's no intelligent system routing between them. Now, let's look at each category, okay? Staking, delegated once, rarely rebalanced, and no performance logic. LSTs, static baskets that give you exposure but no optimization. Restaking, you're stacking yield, but there's no intelligence about where the capital actually goes or why. Lending and DeFi are fragmented across protocols and chains, requiring constant manual oversight. Stablecoin yields are scattered across platforms with no unified view or deployment logic. And here's the thread that runs through all of them. None of these categories have any mechanism to continuously evaluate, route, or rebalance capital based on real-time conditions and institutional policy. That's the missing layer. That's allocation intelligence. So why is this being built now? Why didn't it exist 5 years ago? Four things have converged simultaneously. Yield sources have exploded. The sheer number of networks, protocols, and strategies is now beyond what any human team can track and manage in real time. Institutional capital is here, and institutions don't just want yield, they want systematic, auditable infrastructure that meets their compliance requirements. Operational complexity has genuinely surpassed human capability. Manual management at this scale doesn't just underperform, it breaks down completely. On-chain data infrastructure and AI capabilities to actually act on all of this now exist. The reason this didn't exist before is simple. The data wasn't there, the networks weren't as complex, and the capital wasn't large enough to justify it. All three have changed simultaneously and at once. So what exactly is allocation intelligence? Allocation intelligence is real-time, policy-aware allocation. Let me explain. By allocating capital according to institutional policy to the best validators in real time, assessing their performance, their contribution to the network, and actual reward generation, a unique balance is created between security, decentralization, and yield. The result are healthier networks and better returns for capital owners. Think of it like Google Maps for crypto capital. You define your destination, which in this case is your policy, and the system finds the best route in real time, continuously rerouting as conditions change. Let's give this a little visual look, how it actually looks. So what makes this different from a usual yield optimizer is what it balances simultaneously. Security comes first. By routing stake toward top performing validators with the best uptime, active participation, and strong infrastructure, you directly strengthen network resilience. Decentralization follows naturally. Stake is distributed with intent, not inertia, actively countering concentration. Risk is continuously monitored, slashing history, jailing events, commission structured, all factored in automatically. And yield, well, we left yield last on this list deliberately. It's not the goal, it's the natural outcome of a healthy, efficient, well-secured network. When you optimize for the right things, yield follows. That's the insight Polli is built on. So what does Polli do? Concretely, we score every validator in real time across performance, reliability, commission, slashing risk, and network contribution continuously in real time, not just once a quarter. It translates your institutional policy into dynamic delegation decisions. Capital moves when conditions change, not when someone remembers to log in. And it auto compounds rewards, including MEV rewards on Solana. And critically, and most importantly, Polli does not hold your assets. Not our key. It is your keys and your money. It tells them where to go based on your preference, and we are non-custodial by design. You maintain full control at all times. So everything I've described so far is live. And these are not projections. Let me kind of cover a little bit about our performance. On Cosmos, we're delivering approximately 20% APY versus the market APR of around 16% APR. On Solana, we're running 6.5% versus the 5.9 APY baseline. On BTC5, which is BTC staking with Babylon, we're delivering about 1.1% versus the market average of about 0.6%. On Lava RPC staking, we are at 3.4% versus a 1.8% baseline. These are live on-chain results across real institutional capital. Our system works. Now, beyond the yield and beyond, kind of like, let me share two use cases about our allocation experience. First, on Cosmos, more than 90% of our redelegations were triggered by decentralization and concentration signals, not profitability. We moved capital because it was the right thing for the network. About 1% of all atoms staked on chain has been compounded through Polli, which is a direct contribution to network security and staker returns simultaneously. On Lava, the Lava Foundation came to us because their delegation process was inefficient for a network processing more than 180 billion RPC requests across 40 plus chains. They had approximately 20% of circulating Lava tokens sitting in idle or non-operational validators, earning nothing for their stakers and securing nothing on the network. We replaced that with continuous automated allocation driven 75% by security signals. And as Ignacio, head of product at the Lava Foundation, put it, when validators know their delegation can shift based on performance, they become more proactive. The effect is systemic. Security and yield are not in tension. Once they are aligned, they benefit the network and lucrativity for the user staking to secure it. This is exactly the alignment that we built on Polli. That Polli is built on. Okay, we have just a few more, and then we're open for questions. So everything that is being shown in the today column is already live. Solana and Babylon are very close to being launched. And of course, real capital, real networks, real results, some of which you just saw on the performance slide. Cosmos, Solana, Lava, Babylon, staking and restaking across all of them. MEV compounding on Solana already running. Near term, we're focusing on opening the EVM ecosystem and Ethereum staking, the largest staking markets in the world. And the horizon is exactly what it sounds like, becoming the allocation layer for all productive capital on chain. Staking is our entry point because it's where the problem is most visible and the market most mature. But the infrastructure we built applies to every yield category we discussed earlier. That's the long game. Now back, to your question about what you asked me where I started. So like I said, I'm very passionate about blockchain technology and crypto. And I think that I can't, like, as I was building this presentation, an analogy came to me. And that's, that blockchains have solved something remarkable, really. They make money programmable. But programmable money without programmable allocation is just an engine without a steering wheel. Every slide that we walk through here tonight, the misallocation, the scale, the fragmentation, and of course, the proof, it all points to the same conclusion. The next layer of crypto infrastructure is the intelligence layer that decides where capital goes. Crypto has infrastructure for trust, for settlement, for programmable money. The last missing piece is allocation, and that's what Polli is building. Let me leave you with something specific. To those of you in the crowd who are already work with or know a foundation, a validator, an institutional investor, or a treasury manager, if you're a foundation, we can take your delegation program to the next level, running it according to your policy and saving you 4 to 6 months of expensive manual labor in the process. If you're a validator, let us show you how you're being scored and help you improve your profitability and standing within institutional delegation programs. If you're an institution or treasury, let's execute our allocation policy together. Find us after the session and we'll be happy to show you exactly where your capital is underperforming and how we can improve it together. Thank you very much. Let's have some questions.
Yeah, cool. Thank you. Let me start with maybe the first thing. So how much of this is artificial intelligence and how much of this is kind of humans doing hard-coded structures?
So, wonderful question. We started, yours truly, started with manually moving delegations across validators and manually compounding. Okay.
Yeah.
Now, as you can imagine to yourself, it was a lot of fun. It took a lot of my time. It took a lot of frustration. It was really, really slow. And when we started automating it, we started hard coding it. Okay, like you imagine, we went with a more algorithmic approach.
Yep.
And then we understood, as we were looking at our data, that we were actually learning a lot from the different redelegations, compounding transactions which we generated, and we understood that basically we wanted to bring in a learning, kind of like a learning loop, and that's when we decided to kind of like bring in AI. Now, AI is involved in the recommendation mechanism and deciding which validator to delegate to and how to balance the portfolio and other parameters which we bring in, but it's not fully AI. It's very important to mention our AI follows specific policies which are defined by our users. Okay. Now, Polli today, if you go to polli.co, Polli, you're going to go into Polli's permissionless product. That's that's our original strategy, our original allocation mechanism, which is more kind of yield oriented. Yet we managed to balance it to security, decentralization, and yield across each protocol that we go to. Our enterprise product, which is more for our B2B clients, that's our core focus. Allows our users to determine their policy and actually basically determine which sensitivity they want to delegate according to what factors they want to turn on and off. If they want customized factors, then it's something we can always help them with. For our enterprise clients, we're a lot more hands-on and a lot more white glove service because each one is very different from the other. And that's essentially once you put that in the defined confinement of that policy, the agent runs and learns how to better optimize the results which it's being given. So I hope that answers your question.
All right. Nonetheless, if I mean, my background is in traditional financial services, and there have quite often been people saying, don't take your decisions individually or manually, but trust in my system, which picks the best shares or which shows you the ideal allocation of. And many of these systems either had the problem of well, being manipulatable. Were always fearing that someone may set certain parameters so that it only identifies. So what happened in the traditional markets is that many of these kind of fund selecting software would only allocate these funds that have the highest commissions that would pay out and so on. So manipulation is something that used to be a very relevant issue.
Correct.
If you were to say no one can manipulate our system, that might be a claim, but how can an investor be sure that this will always be kind of objective and reliable?
So this is thank you for that question, Moritz. It's a great question. Each one of our enterprise clients decides, like I said, they determine their policy. We do not have access at all to their system. Not
Yeah.
only that, the way that we have structured our enterprise product is that, first of all, you don't connect the wallet. Okay, you enter the address of the wallet, and we go through a read only. We view the wallet in a read only view. But once you define the policy and you want to execute it into your wallet, first of all, you have to really understand what you're doing and entering it into the multi-sig wallet, and the actual user puts the transaction in themselves. We never do that. Okay, so they can review the transaction, they can make sure that everything there has been, is fully bulletproof. Side note, we have been audited by Hacken. They have fully approved us that we're legit and everything is working great. But even more so, we took much more rigorous approach exactly for that purpose. So we cannot access the enterprise client's product. We do obviously we are not interested in having access to their wallets or their keys. On our permissionless product, we request a very minimal amount of permissions. For the enterprise product, we request even less. Okay, we really request the bare minimum that we need in order to actually optimize for the and allocate automatically for the client. We are not interested in requesting any further permissions. And again, the users, by the way, the people who can enter the system are a limited list that we receive. Okay, those are hard coded. Okay, and they're upon request only because exactly of that. A user cannot add other users to the system that can access it and mess around with it. So we're taking the utmost, most rigorous, really, precautions exactly for that question. Now, in terms of what you said about objectivity, I
Yeah.
mean, listen, I'm going to say it out flat out. At the end of the day, every user uses their judgment and their objectivity. That's exactly why we created the option to customize your allocation intelligence and how that's going to work according to your policy. Okay. Now, if let's say there are certain parameters that we do not offer, we will offer them for you. Okay, we will open them up for you so you can really, really work around that. Now, obviously, that's customizable at any point, at any time that you want, but again, restricted only for those who have access to our system.
Regarding your commission? The commission is based on the yield I generate as a user, or what exactly is the
So
base for the commission?
the
How
commission,
do you earn money? Yeah.
great, wonderful question. The commission we charge is for our overperformance. Okay. For our that's on our permissionless product. For our enterprise clients, we have a maintenance, an annual maintenance fee, and we have a certain commission structure which we individually with each client, we discuss and we come to an understanding about. But again, that is, our goal is to really ensure that our clients enjoy the most. First of all, we believe that they deserve to receive the bare minimum of what the network generates. So anything below network, we don't take a cut. We're not interested in taking a cut because that we believe that is the clients. Now, anything above that we do generate, the alpha that we generate, depending on the client, depending on the size of allocation that they want to be putting in, then we have a certain commission structure. At the moment, on our permissionless product, we collect about 40% of overperformance for Cosmos networks. For Solana, it's going to be a little different. But yeah, that's in terms of how our commission works.
But can you clearly identify how much the outperformance which is attributable to Polli for an
Yes,
individual
of course. Of
investor?
course, of course, of course. Let me share that slide again. So these are currently our overperformance numbers. So
Yeah.
on Cosmos specifically, we deliver 20% APR versus 16%. But I want to say that our average on Cosmos networks has been around 20% above market APR, more or less.
Yeah.
With Solana, we're stabilizing around the 10%, kind of 5 to 10% range, above market APY. And BTC 5 with Babylon, we're seeing some significant numbers there. And of course, with Lava restaking, when we help them balance their RPC network, that basically creates efficiency in the network, which delivers the additional yield. Now we are researching, for example, in EVM, we're seeing more opportunities there. We're seeing efficiency opportunities there. But I mean, if we were chasing yields about a year ago, we understood. This is actually something that's important for me to mention here. The more we believe that as time goes by, networks are going to be secured more and more. You can see this on Ethereum, you can see this on Solana, you can see this on Cosmos, you can see that on a lot of networks, that staking is becoming something that the demand for staking is on the rise consistently. Okay. Now, as networks, get more TVL locked, get more stake delegated into the protocol, that inefficiency is going to really shrink. But with that, the need for allocation is going to grow tremendously. Because I do not believe that there's going to be a case that the network is going to be 100% secured. Okay, I mean, it would be wonderful, but it's unrealistic to think that way. But even let's say it's secured in a very, very high ratio, 90%. Okay, the higher the ratio will be, the higher the need for allocation will also be, because you're going to have to decentralize a lot more. You're going to have to measure performance in real time a lot more. So this need is actually only coming and grow, basically.
Got it. Yeah. Any other questions from the or small audience today? Please feel free to put them in the chat or give me a sign then when you want to talk. For me, one other question. You mentioned that security is kind of the highest level, and I think when looking into new technologies, it's always tricky to determine what are the parameters to identify higher levels of security and lower level of security. And is all this eventually there's or tend to be a factor that's the kind of gut feeling or whatever. Is everything relevant for security clearly identifiable by just looking at hard data, or are there other components from your point of
No,
view that are?
no. Here's the thing. Here's the thing is that you need to analyze data in real time to really measure, the contribution of a validator to a network security. Okay. It's beyond just uptime and, block creation rate, which those alone, you have to really measure in real time all the time. So static data doesn't really apply there. Okay. But I mean, we see that, participation in the network. So the validators, I mean, the part of the job of the validators, again, I'm saying this as a validator. And by the way, I don't treat myself as a good example. I'm busy with Polli, so I don't treat unfortunately, I kind of like left my Ethereum validators behind. But, like a good validator really contributes to the network, is participant in the network, pays attention, to how much they contribute to the network. And it's not just from, validation purely. Okay. I mean, their participation in governance is extremely important. Okay, because it essentially creates a network that is censor proof. Um, the more, the more obviously the more validators, the more effective validators, the delegation gets spread across, and the more decentralized the network is, the more secure it is. And again, back to your question about, just by looking at data, is that enough? I mean, yes and no. Okay, it depends which data, depends on which velocity, depends, on how often you look at it and what type of data. But at the end of the day, when you put it all together and you really need to make real-time decisions, you have a lot of parameters. And at the end of the day, you really see how this balance truly, truly contributes to the security of the network. I think that one of our best examples really is lava. And at scale today, I mean, us working with the foundation, so we actually see at scale how this contribution really helps balance out the network, two networks in their case. It's their native network and their RPC network.
And how, so for example, with Solana, in order to get the additional 10% plus kind of, how
Mm-hmm.
often would an investor move the validator? Is it
So,
something that's happening 3 times a day, or every 5 minutes,
no, no,
or
no,
just
no,
once a
no,
month?
no, no. So Solana is a completely different beast. Solana, obviously you can redelegate there, but there it's a lot more. You have to be a lot more calculated, okay, over there in terms of like how often you redelegate. Technically speaking, you can redelegate every 2 days. I want to say, like practically speaking, every like 1 to 3 days you can call it. Okay. Does it make sense to you? Not always. So that's another thing. So like you would have to really calculate, and really you would have to be very calculated in your consideration to why would you redelegate to a validator? Okay. Because for example, on Solana, when you redelegate, you miss rewards of the following epoch. You start to basically generate rewards after, let's say you redelegated from epoch 0 to epoch 1, you will not receive rewards on epoch 1. And then you only start receiving rewards on epoch 2. So you have to calculate how much is it actually worth it for me to delegate for this, during this epoch, how much yield should I be missing out on? What's the actual impact that I'm going to be absorbing if I do redelegate? We do all of that already. And so part of that is identifying, really kind of like predicting who's going to be the best validator, okay, which so far we've been doing very well, I want to say. And it's like the majority of our alpha that we generate on Solana comes from our allocation intelligence, and from our scoring mechanism. And then we've also, found that there are a lot of idle MEV rewards sitting on Solana. And we found a way to basically compound those MEV rewards for you, which naturally increases, the APY that you're going to be, generating. Now, again, here's the thing: is that most staking pools on Solana do this. They do this in their own way, in their own strategy, based on their own kind of, like thesis and whatever, and kind of like what they decide as their path. And over here, we're first of all we're learning. Okay, we have a learning mechanism that actually learns and sees, okay, where can I improve in real time, all the time. And second of all, we let treasuries determine their own policy. And they're not strapped to one or two providers. They can choose a set of validators, even a set of compliant validators that they want to work with. Okay, they can start working immediately.
But when looking into it, and coming from the traditional market, then you learn that usually the highest return is typically attributable to the highest risk. I don't know if that holds true for, well, not so much for staking, but I would assume for many other forms of yield generation in
That's
the crypto market. How do you kind of balance risk versus return, and is there some kind of a the diversification module
exactly,
in the
exactly.
system? I,
Exactly. Yes. Yes. Absolutely. So great, wonderful. What really very, very like good, very good question. Let me, talk about that for a second. So, when it comes to risk, we we assess a few things. So first of all, yes, what you said in terms of how we distribute across different validators. Not every wallet is going to get the same distribution and proportion per validator. Okay, so that's one. Okay, the allocation itself is kind of like is already something that keeps you from risk because you're not putting all of your eggs in one place, which is, by the way, many big players are doing that. Okay, they're already putting that into one single validator, which creates a single point of failure, which is risky for them and the protocol. So first of all, we distribute it across top performing validators in the network. And again, we assess their performance. We assess, what's their slashing history, their jailing history. In terms of, again, commission, which is less about risk, but still, I mean, it's part of it. So we look at these things all the time. Okay. Not only that, we also measure their actual performance in terms of reward generation. What's their uptime? What's their block production rate? And a few other parameters, of course. Now, according to that, what our agent does, it determines what is the right proportion across a few validators. Okay, because let's say a smaller wallet might not need to be spread across too many validators. Okay, but a larger wallet, if it is being concentrated in a small amount of validators, it might not generate the top performance that it wants. Okay, so at the end of the day, we found that balancing this concentration in real time, okay, and distributing it accordingly, proportionally, and learning from it is a big risk protection mechanism.
okay, fair enough. I've been to a conference in Germany this weekend in Munich, and there was someone from the crypto space presenting a stablecoin yield generating kind of offering where they would take the decisions. And he was quite actively promoting this as a alternative to a classical kind of bank deposit, and was doing this kind of, well, with your bank you get only 2%, and with us you can get 4 or 5% without a higher risk. With your experience, and well, do you personally have any money left with the bank, or so? Which is more secure? Can you compare the current status of generating yield with crypto versus giving fiat to a bank, which has a risk associated with that as well?
Yeah.
Is there or is it fair to say this is comparable, or is it just different worlds, and therefore you shouldn't try to compare these?
I don't necessarily think they are comparable. And the reason for that is because obviously the regulation on banks is far heavier, especially on yields. It's also attached directly to the yields, that the central bank gives you and enables you. Now, specifically for stablecoins, at the moment, the vast majority of yields being generated from stablecoins come from T-bills. Now, that is, the rate there is what the central bank determines for it to be. Um, there's no room for, maybe, I don't know, maybe you have one T-bill provider is going to give you a few bips more than another T-bill provider, but they're very fast. They're very quickly going to balance out. Same thing as banks. Now, I believe that in the near to midterm future, we will see more avenues for stablecoins be generating yields, but again, I believe they will be a little bit more risky. And when you bring staking into the mix, I always say this, like staking, at the end of the day, you receive native token. Okay, native tokens are volatile. Okay, it's important to remember that they are volatile. Okay, they're not stable like stable coins. So it makes sense that their yields are going to be probably more attractive. Okay, not in all cases, by the way. Okay, some are less attractive. Okay, but it really depends. The question being asked, and this is kind of like I'm going back to what I said at the beginning of our call. The fact that you have an option to generate yields in native assets, okay, that secure a network that runs hundreds of millions, if not billions, of transactions. To me, I find that very fascinating. But again, it's a whole other asset class. It's a whole other observation. I also believe that the two are inevitable to be tied. Okay, that's one of the things that we see with allocation intelligence. It's one of the reasons why we decided to start with staking, because staking is the lifeline of blockchains at the end of the day. It's what powers blockchains at the end of the day. And if stablecoins are going to be running on blockchains, then you're going to need blockchain security power, which means that in the long run, the value of these assets, which are securing the networks, is only going to go up. Okay, again, depends on a lot of things, obviously. But that's what I'm saying. Like stablecoins and staked assets and native assets, they're not really comparable in the way that they generate yield.
And the last question, we get to the end, and the potential of crypto lending. Do you think that at some point in time the lending volume will be higher than what is deployed in staking protocols, or how do you see the future of crypto lending?
Eventually, yes. If we're looking at a world where, I personally believe that we are stepping into the new financial rails, which are blockchain based. And at the end of the day, the current volumes of lending will surpass, I believe, the volume of staking, just because, the market there is far, far bigger than what staking is. With that said, the bigger the market, the smaller the returns are going to be. Okay, so because that's just how it works. Now, again, each kind of like category which you've labeled here has its own rules, has its own kind of like game plan, how it works. It's literally like we spoke about three different yield mechanisms, which each one of them works very differently, and is affected by very different measurements. And yeah, lending. I personally believe that crypto is, or blockchain in general is the very natural next evolution for lending. And by the way, we see, we are already seeing some sort of connection between staked assets and lending, and how you can kind of like optimize there. So I believe that a lot more of these developments are we're going to see them in the near to mid future evolving and coming up, which is going to make those markets even bigger, in my opinion.
Yeah, I share that view, but very, very helpful to to hear from your experience that this is your point of view. All right. Even though there have been no further questions from the audience, I think it was extremely insightful, and it's a pretty cool project that Polly is doing, and what you are offering, and definitely, I think you have addressed an issue, and well, wishing you all the best. Qualix is invested. So we have our own interest in you becoming, achieving your goal. With
Okay.
that, thank you very much. It was a great pleasure having you, and
Thank
wish
you. Thank
you
you for having me,
all the
Moritz.
best, Eli.
Okay.
Thank you. Goodbye.
Okay.
Cheers.
Bye.